Good evening, everyone, and very warm welcome to tonight's webinar on property investing. Thank you so much, everyone, for being here. If anybody would like to just share what made you join tonight, put it in the chat box because I've taken off the unmute button. We can unmute towards the end, but there was a lot of background noise. So what made you join tonight? And I also want to just say, many of you may not know me. A lot of you here do know me, but those who don't, we've got some more people joining. Sorry, one second. Okay. So my name is Jeanine Shaka, and I actually have two businesses. That's why lots of people here know me from my personal development and training business. I'm a trainer of the Silver Method and Louise Hay's work as well, and several other things. I'm a coach. However, I also do property investing, and I'm a senior consultant for 2020 Property Advisory. So just very briefly, I know 2020 Property Advisory because I was originally a client of theirs way back in 2012. And I had never had an experience that good before buying an investment property in my life. I'm from South Africa, I bought some there. But it's all backed by research. So we're a research-based property advisory business, and I'll take you through who's the owner, and we just kept in touch, and I was very blessed and fortunate about a couple of years later to actually, get the opportunity to sell for Mike and help clients invest to create wealth through property, because obviously I believe in what they do. All right, so I'm going to dive right in. Some people are still joining, so if I'm clicking around, I do apologize. There's still some people in the waiting room. All right, so getting right into it, what I'm going to be just covering off tonight is just an overview of the research. So if you missed what I said earlier, we're a research-based property advisory business. So everything we do is based on research. So I'm going to give you a quick update over the total market. I'm also going to let you know about some new legislation changes because they are quite big changes and they do affect investors. Then I'm going to just show you a couple of the drivers of market growth. And I'm going to also show you some of the opportunities we are offering clients at the moment. Not all of them. These are some of them. I haven't got time to go through all of them, but I'll take you through a couple so you get a bit of an idea of what we do. And I'll also show you like what smart investors are actually doing now, how they're positioning themselves. And last but not least, it's not on the agenda, but I'll show you some results some of our clients have got. At any stage, if you'd like to ask a question, I'd appreciate it in the chat, is to write in the chat to everyone and try not to write just to me. Otherwise, there's a whole lot of chat boxes that start to open and I'm the only one here. All right, so the licensee and owner of 2020 Property Advisory is this very wonderful man, and he is wonderful. His name's Mike Anderson, and he's the guy who first got me into an investment property back in 2012. And he was so kind and so thorough with me. And he asked me so many questions. And when he met me, he asked me what I owned and if I had anything else. And I said, yes, I bought this property in Geelong from another property group. And he said, when did you buy it? And I told him, it was just like a year before. And he said, oh, that's never going to go up. It's going to go down in value. If I was you, I'd sell it. And I thought, he's just saying that property's not going to go down. Anyway, I bought one or two properties from Mike. At that stage, it was still Sydney. And every time I caught up with him, he kept asking me, do you still have that property in Geelong? And I said, yes. He said, well, I would sell it. It's going to go down. Anyway, I held on to it, and he was quite right. I had it for 6 concurrent years. It was a brand new house and land off the plan. But when I did sell it at some point, it did go down. So I actually made a loss on that of $35,000. I'm not sorry that I did that because I sold it in the same year through Mike's very good advice. In the same year that I sold one of the ones I bought from Mike that made a huge profit of $180,000. So we offset the capital gains tax. I said sell it in the same year. But the point I want to make is the first property group I never saw again. They put a lot of information in front of me, and the next thing I signed something and I bought something, and I never saw them again. But Mike and all of us at 2020, we have long-term relationships with our clients. We know all of them, and the people that Mike put into property 30 years ago are still our clients to this day. So I'm just letting you know that we value long-term relationships. We're not a big property, massive group that puts 300 people through a seminar. We're small, we're boutique, and we know everybody that we deal with, and they generally stay our clients. They just sell when it's the right time and invest in something new when it's the right time, and slowly over time create wealth using property as a tool. So Mike's got fantastic experience. He's one of the most knowledgeable people I personally know in this industry, and I'm not exaggerating. He started off actually doing financial planning, and he was a broker, a mortgage broker himself. So he did deal with debt and finance. He also did over the years developments himself, but most of all, he's done sales, helping clients invest in property to grow wealth. And he always used property research as the tool to make sure that they get a good result. And I can say hand on heart, he's done that successfully for 30 years, getting clients a good result. So we don't advertise a dollar. The only way we get business is through referrals or word of mouth. And the performance of our clients is our marketing. It's the only marketing. If we do well, they'll tell your brother, your sister, your friend. So that's what we really stand by. All right. Our team is very small and boutique. We're a small team. Pearlie runs the office and a lot of the paper flow. She is also an agent and does sell as well, but she really runs all the paperwork. Then there's myself in sales. Then there's Helen, who does the finance. Ola is in head of marketing. And we've got a new little team member now, not little, but a new young team member with us, who's Scarlett, and she's in charge of marketing communication. So you can see we're a small team, very personalized. All right, so let me tell you about the business model, because this is really the most important thing. So as I said, we use property research to identify areas of strong potential growth. And we match that to our client and the type of client and what they have and what they're trying to do and their objective. So just very briefly, with the research, what we look for is a mismatch in supply and demand. And we go from the national level. Then we look at a mismatch in supply and demand at a state level, and then down to a local suburb, or what we call local government area. And why? Because it's just basic economics. If there's a shortage, so there's no supply, and a high demand, prices go up. And when there's an oversupply and no demand, prices go down. So we just use basic economics to identify the area using that strategy. Once we get into the area, we then look at reasons for population growth. And I'm just letting you know this so you can educate yourself, and I'm here to educate you. One of the biggest reasons for population growth, people, is jobs. So if anyone's selling you a property in the middle of nowhere, like my first Geelong, it was out there, the farmlands were converted into residential. There were no jobs. There was no infrastructure there. There was nothing going on. So that's why there was no growth. So we look for areas where there's a reason for population growth. There must be infrastructure investment and development, by the private sector as well as the federal government and the state government. Anyway, then the very important next thing we look at is demographics. Why demographics? Because we want to know, are we looking for a 4-bedroom house for a family, or are we looking for a 1-bedroom townhouse for maybe singles and couples working near a hospital? It determines the asset type that we select for our clients. And then I spoke about infrastructure. We're looking for everything: shopping centers, public transport, medical facilities or a hospital, schools, everything has, and obviously new jobs as well. So infrastructure, whatever's being built, new reasons for growth. Then we look at the entry options. That's like what you put a client into. So we find the option to help a client invest. Now, the most important part of our model, that we don't know anyone else in the business who does this, we look at exit. So people say, what are you talking about? What are you talking about exit? So, well, before we even select a property to put in front of a client, we ask ourselves, what about the exit strategy? What that means is we ask ourselves, who would buy this property off us for a profit in the next 3 to 5 years? And if you can answer that question based on the research, you mitigate an enormous amount of risk. So you know exactly why you're buying the property, and your goal is to make capital growth, not in the next 20 years, because everything goes up in 20 years, but in the next 3 to 5 years. And obviously maybe sometimes it takes 7 to go even further. But we don't want to wait 10 years to make a result. If anyone says that you're going to make your property will go up and they show you 10-year forecasts, please understand that's not actually a good investment because they could sell you anything. Like my Geelong property, it didn't go up. I had it for 6 years. All right. Then we connect this to the client. So what we do with our client engagement, let's just look at it like a clock. Let's go to 1 or 2 o'clock over here. We meet a client for meeting number 1 and we understand their goals, their objectives. We then define their capacity. Hopefully they've seen a broker and they know how much their capacity is. We educate them with the similar information I'm going to talk to you about tonight. Then we'll go away with all the information about their situation and their objectives, and then find the most ideal property for their personal situation. And every client is different. Some people have loans, some people don't. Some people want to settle as soon as possible. Some people want to settle a year from now because of situations with money. It just depends. Some people want to buy a self-money super fund. So depending on the client, we then present an option at the second meeting down here. Okay? And then we discuss the strategies. If the client says they're interested and it looks good to them, then we say, great, let's at the moment jump on a plane and let's meet you at the area, because at the moment it's mainly Queensland and we're doing some investments in Victoria as well now. So we'd meet the client there, take them on a tour. Tour is about 3 hours, 3.5 hours, show them the actual area, all the infrastructure, all the visible evidence for capital growth. So you have to see it. If anyone's selling your property, says, oh, I don't have to go visit it, it's okay, just sign the... No. If you're going to be spending, anything between $500,000 and $1 million in investment property, you would benefit hugely from going to see it. And once you see it, it's better than paperwork research. It's the real research. When you're on the ground and you're driving around and you can see the shopping center over there, the hospital over there, and the real reason for growth, it all makes sense. You get excited. And then if you want to go ahead, we help you with the implementation. It says implementation plan support. We don't do it ourselves, but we've been in the industry for 30 years. So we know people who are brokers, handover, inspections, depreciation schedules, managing agents, conveyances, whatever it is that you need, insurance. We have connections and many times we have good discounts for our clients as well. Then the client would get into the property. And from then on, we would review your portfolio for as long as you have that property or a client of ours. And even if you had 2 or 3 or 10 other properties which you didn't buy from us, we would even review those properties on an annual or at least 18-month basis so that we can let you know if your portfolio over time is going to achieve your objective. So I hope that makes sense. All right. Now, why do we talk about an exit strategy and why do we actually talk about selling? Well, we do have an exit promoting strategy. We don't believe in buying and holding forever. Now, when I met Mike Anderson, the owner, I never wanted to sell any property. My conditioning from my parents and my grandparents was when you buy property, you never sell it. Well, you can do that if you want to, but it's not effective. And I'll tell you why and why we promote selling. We don't promote selling instantly, no, with a proper couple of years in between, but you make more money and I'll show you. This is in theory, okay? What we find is the property market grows at an average of 8% per annum, let's say over a long term, but it doesn't grow in a straight line. It has these short, sharp upswings in growth, and then it's bound to stagnate for a long period, approximately a decade. You can go and look at any market you like, you'll find this is true. I've just put these markers with a year below because if anyone goes to have a look at the property market growth between the year 2000 and 2003 in Sydney, not everywhere, just Sydney, it shot up. But then from 2003 all the way to 2013, Sydney market never moved. The prices stayed exactly the same. However, when it flattened, another market took off. And when that market flattened after its growth period, a different market took off. So, if you understand this, you can be highly effective in growing wealth with property. Every investment is going to do exceptionally well. Now, that's theory. Let me show in practice. This is actual clients, actual numbers. This is not made up stuff. But in the year 2000, we put clients into properties. It was the Sydney market back then. And property prices, honestly, for a townhouse, were in the 300,000 price range. As I said, from 2000 to 2003, the Sydney market took off. At 2003, we at 2020 said to clients, according to the research, sell your investment property in Sydney. The next market to take off is Perth. And as you can see, it's slightly below. Why? Because we're taking into account exit and entry costs. That is agent's commission, stamp duty, legal fees, and then capital gains tax. And the property prices were slightly less than they were in Sydney, in Perth. And then the exit and entry costs, yes, you pay them, but you make them back in the next 6 to 8 months. But the market shoots off beyond that. So then Perth took off and did really well for the next couple of years. And then after a few years, we said, according to the research, sell Perth, we're going to Darwin. Again, paid exit and entry costs, prices were a bit lower, Darwin shot off. Then we said to clients, sell Darwin, the next property market to grow is Melbourne. I'm very glad to show you that Melbourne is not a perfect world and it went like that, which is normal and great to see as well. And then from the year 2009, actually, we started saying to clients, sell wherever you are and put your money into Sydney. Sydney is the next market. So we started putting clients in 2009. Anyway, this is an actual client. So they sold in this year, 2012. And we said, put all your proceeds, sell everything, put it into Sydney. Now you can see by this stage, the line up here is 1.1 million. I just want to make it very clear. We never put anybody into a 1.1 million property back in 2012. We probably put them into 2 properties around the mid 500 range. And then you can see the property market in Sydney went crazy and it shot off. Now, some clients said, no, I'm never selling property, like I was before I met Mike, because my grandparents said never sell. That's their choice. They can hold on to it. But look at the client who did hold on to the first investment property, where he landed up in 15 years. My friends, the price difference between this and where this one landed is $880,000 more money in a period of 15 years. It is significant. And this is on the old pricing. Today, things cost a lot more and there's bigger numbers in the growth. Now, the point I want to make is this is a managed portfolio. You don't just buy it and forget about it and never look at it again. It's actually to look at the properties you own and say, oh, they're actually growing my money. Because if they're stagnant, like the one that stayed in Sydney for all these 10 years, this person hit 2 to 3 markets in those 10 years and made capital growth on every single one of those cycles. So we just promote that and we recommend that to our clients. All right, so our exit point strategy, what we're actually doing right now, where we are in Queensland, we're actually currently implementing the exit point of our strategy in certain suburbs that we put our clients into about 2 to 7 years ago. So we're actually contacting them and saying, you've reached the peak in this particular suburb, let's say it's around Brisbane, and this other suburb over here is at its beginning of its growth stage, and if you put your money into there, you've got growth for the next couple of years ahead. So we don't do it ourselves, but we do facilitate the sale of our clients' investments with significant capital gain. And this has allowed people who've now sold and maybe made 200,000 or whatever profit, they can help to get the debt down on their own homes. Why? Because the interest on your own home is an absolute expense and a very expensive one and a big waste of money. But debt on an investment property, okay, I'll explain it later. There's some changes in legislation, but it's tax deductible. So this debt is not good debt. What's wrong with the presentation? Hold on, guys. There we go. Okay. This also allows for clients to reinvest into new tax-effective growth assets and obviously very happy clients. Just want to mention, we do partner with the best of breed sales agents. There are many people here tonight who have been recommended to join this webinar from R&W in Rudy Hill. I just want to say that they sold my own investment property back in 2015 in Sydney, and they got me the best result that suburb had ever had up to that point. And they actually also helped one of my very best friends sell their property just about 2 years ago, maybe. And they got the highest result in that suburb as well. So they really are a fantastic agency, and I couldn't speak more highly of the owner, Roy Amory, and his team. They are fantastic. And then in Queensland, we have others. Please, if anyone does have an investment property in Queensland around Brisbane area and you think of selling, just be aware that there's such a chronic shortage at the moment that agents could be lazy and sleeping and they will still sell and make money. So they're not really working very hard for the landlord, for the seller. So if you want a really good agent, we have one. Again, they have reached all the targeted record sales in every suburb, in every development. So please contact us if you want their name. We don't get anything from them. There's no money exchange. They just are really working for the best result. All right, so where are we right now in the market? Just a little bit of market overview. Right now, there's a chronic shortage, okay, of property in the whole country, but certain areas is worse than others. So the demand for housing just continues to exceed the supply. And let me just tell you, in certain areas like Brisbane, Sunshine Coast, Queensland, they could not keep up. They're never going to catch up even for the next 10 years ahead. The gap between supply and demand is very wide. And there's a shortage of tradies. And then with the Olympic Games coming, there's even a bigger shortage. So new housing can't keep up. And continuously, the population continues to grow in Australia. And, international migration. And there's also interstate migration. So what does that result in? Well, the prices and the rents just continue to rise, even at a higher interest rate environment compared to what we saw in like the COVID times. So just the drivers of growth, the housing shortage I'm speaking about, upward pressure on prices, also on rents. Rents keep going up. Now, rents going up is not good for a person renting, but as an investor, our investment properties that we have in the areas we have done exceptionally well with rental yields. The demand is sustained because of the population growth I mentioned. And then construction, there are massive construction constraints at the moment. So that's limiting how many houses they can actually bring to market. And that's why the shortage just stays the shortage. As for infrastructure and lifestyle shifts, that causes growth in regions like Sunshine Coast, for example, is a very attractive place to live lifestyle-wise. Also affordability, that's what we're looking at the moment in Victoria, in the areas you're putting clients into. It's about affordability play, and that's causing the growth because affordability is a massive issue in Australia. So where prices are very well placed and it's in the right area and it's close to jobs and public transport and amenities, the demand is very strong. And then, of course, with government incentives and first homeowner grants and things like that, continuous demand. All right, so if anyone saw a webinar prior to tonight, you would have just heard me say Queensland is our market, and I've been saying that for years now, probably 10. However, now I'm saying limited opportunities in Queensland because the market is changing, it's getting quite expensive. We wouldn't recommend investing anywhere in Queensland. So if you're not sure of something that you've seen, you're welcome to speak to us. It costs you nothing. We will not charge you a cent, but we'll give you honest feedback about the area. So there's still continuous strong interstate migration into Queensland. It's an incredibly strong job market. Some people don't realize that. They think that all the jobs are in Sydney, all these other major capital cities. But Brisbane and Sunshine Coast are incredibly strong job markets. There's also multiple pillars of employment. And I'm talking about places like Queensland compared to places like Perth, where they're very reliant on mining and resources. So if China has a problem or there's a war in the world, prices can change very quickly in a place like Perth. But in Queensland, there's all pillars of employment, a good spread of them, from massive medical, retail, tourism, lots more. All right, and very good lifestyle, the weather and the lifestyle there. Major infrastructure pipeline. There's been so much incredible infrastructure, in the last 10 years in Queensland. It's incredible. If anyone hasn't visited Brisbane for, say, 10 years, you'd be shocked if you actually went there and see what it looks like today. It's really matured. It's vibrant. It's funky. It's just fantastic. All right. Then relative affordability, yes, compared to Sydney, but now the prices are getting a little bit up there. So not all areas, we're only in certain areas now in Queensland for affordability. But it does offer still very good potential growth and rental results are fantastic. Okay, we're in Victoria in just a few places, and why we would be in Victoria. Well, the key drivers now is that the building cost is way cheaper than Queensland. We've got some incredibly affordable options. We've even got house and land packages, please listen to this, where the land price is under 250,000. I mean, where do you get that? We haven't seen that in years, but there are some options there. So it's from affordability point of view, it's a good investment to hold. The market in Melbourne, for example, hasn't moved in 10 years. It really struggled through COVID. So many people left. The greatest interstate migration out of Victoria in all of Victoria's history happened during COVID. Went from 13,000 a year to 20,000 a year, and then went up over above 30,000 people a year were leaving Victoria because of the strict rules there during COVID. So it caused massive stagnation in the property market because there was a lot of supply and less demand. Well, now it's coming back. So strange English. It should be a lot. Anyway, I'll fix that. Okay, a lot of population. A lot of population exited during COVID, and they went to Perth and Queensland, and they're now returning back to Melbourne, places in Victoria due to affordability. So there's still a mistake there. Lots of population exit. That's what I meant to say. Okay, there's also land tax confusion. There's a lot of talk about land tax. So I just want to mention that in the places that we've looked at, we've calculated what the land tax is, because the land tax is significantly different, okay, in Victoria versus other states. And people are very scared of it, and they think, oh no, I'm going to be taxed to the eyeballs. Well, you won't. So the land tax on some of our investment properties is only about $900 a year, sometimes even less, because the land is priced under $300,000. So it's not, we've taken it into account. We would never want to put a client into an investment property and then they get a terrible shock of the land tax bill. So we are putting that on the table so you understand, what it's about. Now, there's also very, very amazingly designed master plan developments in the areas we're looking at in Victoria. They all new. They're very well designed. They've got a very good look about them. We are putting clients into some terraced homes, very attractive facade and design. There's, for a certain postcode, the one place that we've put clients into, which is very attractive for them to rent it out or sell it one day to a future homeowner. It's got a clubhouse with pickleball and tennis courts and a full gym and rooms to hire at no charge if you're a resident. So all you need is that postcode. So if you're an investor like us, you would only increase the rent for your tenant by $20 a week, and they have full access to a full gym, the swimming pools, the pickleball, the event center. There's a coffee shop in there, really beautifully designed, like a country club, but it's a clubhouse of the suburb. So you can pass it on, very attractive to your tenants. And of course, to have that as an option to sell in several years' time to some homeowner is a really nice option. Okay, again, offers growth potential and a strong rental demand because of affordability. All right, legislation changes have scared a whole lot of people. So I'm going to take you through them that you understand. The negative gearing is restricted to new builds only. So what it means, when the government made its change in May, when it did the budget, is that they have lessened the negative gearing. So if you buy an existing property, you can't offset those losses against your income tax. So you used to get, in the past, let's just say you bought an investment property, and let's say it cost, I'm just going to make up numbers that I know are real. Let's say it cost $500,000. A person would get approximately $6,000 to $8,000 back in tax a year, just with a standard deposit kind of thing. Now, if the property is existing, you can't claim any deductions like depreciation, interest, expenses But if the property is new, a new build, you can. It stays the same. So I'm telling you this because if you're going to buy an investment property, if it's from us, we only sell new for this reason and always have only sold new. And also there's no maintenance and it's under structural warranty. But if you're not going to buy from us and you're thinking about investing, please do yourself a favor and make sure you buy new, because otherwise you miss out on a huge amount of tax back. And it's significant. All the depreciation, all the expenses. Okay, that's the first change. The next one is the negative 50% capital gains tax discount is being replaced on existing properties. So they have a different way to calculate it. There's a 30% minimum tax on that, and it's on this kind of specific way they're going to calculate it. However, new residential builds are the exception. Investors can still choose the old 50% discount if you want to. So it's a lot cheaper. I can tell you the 50% discount makes your capital gains more or less, it's not exactly, but they take 50% of the gain, add it to your income, and you get taxed at your tax rate. But if you're working out what was it actually as you've calculated as a percentage of the total gain, it's normally something around 22-23%. So you can see the one above at 30 as a minimum is significantly higher. So again, if you're buying an investment property, make sure you buy a new build. And the reason the legislation's all around new, it's because there's this big housing shortage and the government isn't solving the problem. They expect investors to solve the problem. So they are only rewarding people who are buying new. I hope that makes sense. So what this means for clients is that the tax gap between, established properties and new properties is wider and wider. It makes a big difference. So I just said here, this is a genuine reason to be talking to us about new builds and off the plan opportunities now. So I wouldn't really recommend anyone buy an existing property that's not new for all these reasons. It's going to be a significant different result, compared to buying new. Oh my goodness, Al, small world. I bought 2 properties from 2020. I worked with Pearly. My goodness, high five. Great. Yeah, Pearly's still with us. She's actually took a plane today. She's going to South Africa for a bit of a fun time watching rugby. But that's nice that you bought from us, and I'm sure you did well. All right. Then buying through a self-managed super fund has also got legislation changes. Now, I just want to mention this is an unfortunate scenario. I'm really not happy about it at all. We did a lot of deals to help clients invest in self-managed super funds, and it was a very good idea because you can grow your retirement savings in such an effective way. It was really just wonderful, and now it's changed a lot. Okay, it's a bit unfortunate. So now the self-managed super fund have got different rules for residential property versus industrial or commercial. They've only made it not so good for residential. So what they're saying is you can't have a loan. Self-managed super fund residential property loans are no longer available. Okay? So you can still buy in your self-managed super fund, but you've got to pay cash. So you've got to have, 700,000 cash or shares that you can sell into cash. You can buy it cash outright. Commercial and business are untouched. That stays the same. And if you've got a self-managed super fund like I do, and I have bought a property in it, and I do have a loan on it, but it was several years ago. If it's existing, fine, no change. You'll be okay. Okay, they grandfathered it. So that's the legislation changes. You do need to be aware there's a big difference between buying new versus existing. Right. So how we approach the property market and what's our strategic focus for clients? Well, obviously we only do new builds and always have. For tax deduction reasons, you maximize your tax deductions. You also have, as I said, the least maintenance. Most of the properties are still under a structural warranty when clients sell them for their gain or for their profit. So we are targeting places where there's a constraint on supply, but they're very high demand because prices go up. We do prioritize owner-occupier appeal locations. What that means is we're buying today what someone in 3 years or 5 years' time wants to buy as their own home in a specific area because it's a lovely new area for whatever reason, or it's well located or whatever it is. So we get in earlier, we buy property there, and as the place slowly starts to grow and population moves in and there's new jobs there and new infrastructure, it might take a few years. And then like 3 years from now, 4 years from now, some of these people moving in are looking to buy a home. And if you bought the home 5 years before, whatever, you can sell it to them for a profit. But owner-occupier areas just look better. The gardens are maintained. The properties are well maintained. If you go to an area that's 100% investors, it doesn't look as appealing. So we do that. Then select assets for both growth and rental performance. We mentioned that. So we actually focus on capital growth, but we also are aware of what the rental performance is, because we don't want a ridiculously poor rent. You must have a good rent. And also the main reason is capital growth, which means every couple of years you sell for big chunks of cash. We do focus on strong rental yield. I just said that. We focus on infrastructure, because infrastructure like ticks the boxes. Who would want to buy this property from you? Who would want to rent it while you own it? It's got to tick the box. Okay, it's next to sports fields. It's next to schools for my children. It's next to a shopping center when I need to get something. It's next to a doctor. Oh, if something happens to my parent, it's a hospital around the corner. Can I get public transport to main places? Tick, tick, tick. So that's infrastructure. And we use the research to determine that particular location, and where we are quite confident that we'll get above average growth. All right, just to show you some news headlines. There's a shortage on tradies. It is real. This is one headline: 46,000 worker shortfall as Brisbane 2032. This is the Olympic Games drives construction productivity. There's another one. 46,000 again, construction workers shortfall because the pipeline for 2032 surges. And then just some key facts. This is right. I got this today. It's just been published. Again, it just really speaks well of Brisbane as the population growth remains strong. Economy and job growth outperform national averages, which is true. Demand for housing outweighs supply. Absolutely it does. And it keeps vacancies very low. They're way below average. In fact, in Sunshine Coast, the vacancy rate is 0. And Brisbane is like 0 point something. It's very low. There's no vacancy there. And property prices set to rise steadily over time. Yep, that's true. Just mentioning this. However, with all these shortages in construction workers, and to some degree, maybe materials, because they've also gone up, the next 3 years will place immense pressure on labor. So if you did think about buying investment property right now and you are actually able to, my suggestion is please do not wait. You are going to see prices continue to go up on the build, and we've already seen it happening. It's going to just get even more because there's such a shortage of tradies. So when there's a shortage, people can charge whatever they want to get the job done. All right, so the key takeaways from the research, I'll get onto the properties next, but just before we close, the research is that the markets we're looking at is Queensland, limited, certain areas only. Victoria is a standout. New Bulls is a win on tax. That's due to the legislation. And location plus research gives you the right result. Okay. So let's look at some options. So options and price points. We do have townhouses. Obviously, everything's off the plan. Now the entry level is 685. It seems crazy. Prices have changed so much in the last 10 years, but that's where we're at now. This is the entry point for townhouses. We don't have things less than that at the moment in a townhouse. This is also in Queensland, up to about 850. We do traditional house and land packages. They are excellent for investment. They do really well. When you add value to a piece of land, you tend to get a good uplift in capital gain. We've got packages starting around the early 700s. Some of them go up to just over $1 million. That's again in Sunshine Coast. We do have industrial options available. Right now, this very red hot minute, we don't have a particular item available, but when we get them, we put them in front of clients. So it's something that we do deal in. We just don't have any right now at the moment, but our developers are busy looking at some and getting some more onto the books. What an industrial opportunity looks like is just a concrete shell with a mezzanine, and it's a very good investment from, like, for a self-managed super fund, for example, if you can get that without a construction loan, because it's all the outgoings is paid by the tenant. There's really no outgoing except the managing agent. The rental yield is also fixed. It's also higher than residential. It also has an increase of CPI every year. However, there are risks with industrial property. The risks are it could take several months to get a tenant. So in that case, we have first tenant guarantees. We have rental guarantees on ours, like for 6 months, because we know within 6 months you'll now then get a tenant. And the leases are also very long with industrial. They're like, the minimum is 3 years, 9 years is more common. Sometimes they even go as far as 15. We have display homes at the moment right now. If anyone's interested, we have got 2 absolutely stunning display homes. I'll just show you the numbers. When you see the numbers, display homes have a very attractive rental yield. They're a big cash flow play because you are basically renting them from the builder who needs a display home to put people every day to sell, to go through the display home so people can actually buy the house land packages. So they actually rent it from whoever buys it, and they don't want to own it, they just want to sell the thing. So they spec out this home. It's got beautiful finishes, better than average finishes because it's a spec home, designed stunning, and the rent is guaranteed for 2 years with an option to renew for 2 years, and generally the yield is around 8%. Now if you think of a 4.5% rental yield is pretty good, 5% is fantastic, so 8 is like blown out the water. They are expensive, but they are stunning. And if you bought one, you would definitely make massive capital growth on the capital, on the price itself, and the cash flow while holding it would be very cash flow positive. Just to let you know, all rental guarantees are in place to mitigate client cash flow on every single one of our properties. So if you've got any concerns about, well, what if I don't get a tenant when my property settles? We have a rental guarantee to cover you. So we started in this project several years ago. This is called Nura. I own one here myself, and we're now in the last stage. So we have a few left, and the price of the 1-bedder is 685,000, and the 2-bedder is 840,000 in the Sunshine Coast. I don't know if any of you know about the Sunshine Coast, but it's a fantastic property market. It's continuing to grow, and the reason why we're doing 1-bedder and 2-bedder, some people don't understand it. They say, what kind of product is that? Why would you have a 1-bedder townhouse? Well, the biggest hospital in the Southern Hemisphere is about 12 minutes up the road. And it is such a big hospital. It employs at the moment about 4,600 people. Think of that. And it's got the capacity to employ even more, but it's not at full capacity because they don't have enough people in the medical field to make the hospital at full capacity. So there's a lot of people coming from overseas on contracts, doctors, nurses, and things like that. And they're looking for a 1-bed or 2-bedroom place. Also, there's a lot of retirees who've left Sydney, left Melbourne, taken their retirement savings, and they want to move down for a warmer climate, and they want a 1-bedroom or 2-bedroom. So we don't really have many retirees. The majority of people who are tenanting this, because we do have the stats for we're in the last stage. The other 3 stages are occupied, and they're all young people with good incomes. And they're not blue-collar worker, they're white-collar worker, they're professional people. They're either working at the hospital, the majority of them, some at the university or places similar to that. All right. That's what it looks like, the townhouse. It's got the 2-bedroom and the 1-bedroom kind of on top of each other, like Lego blocks, if you can imagine. And each townhouse of a 1-bedroom and 2-bedroom are sitting next to each other side by side. This is the photo of the 2-bedder. So it's just a nicer design than average. You know, it's much cheaper to close in stairs and carpet them and close this up with a board. This is a lot more expensive, but look how beautiful and open the feel is. Also on the, this is a 2-bedder. On the upstairs, there's a extra high ceiling up there. So you've got this feeling of airy space. The finishes are nice. They're in black. You can see by the fan there. All right. And also the 1-bedders are very nice. Even though it's a 1-bedder, it's got a double volume seating, like a kind of New York loft apartment. So the 1-bedder is 685. The rent's approximately 600 per week. That's what we're at now. And the 2-bedder is 837, and the rent is 750 per week. And these are going to continue to grow. People think, why would I spend on a 1-bedder this price? Well, my friends, up the road, 10 minutes away in Maroochydore, a 1-bedroom apartment is over 900,000. Some are over $1 million. So these are not strange numbers, and this is not overpriced. The market is going to continue to grow by like quite a while, still for a while ahead. So I personally have one of these, great investment. Then in Sunshine Coast, we've got terraced homes. They've got these 4-bedroom. So terraced home, it doesn't actually look like this. One's right next to the other one, and they're all in a row. It's just the brochure's deceiving. These are terraced homes. So the price point here, this is in Sunshine Coast for a 4-bedroom house, is just over $1 million, 1.05. It's a 202 square meter home. The rental is about $890 per week. Sorry, don't know what that's there for. Okay. And you've got a 6-month rental guarantee. These are the terraced homes we're putting people into in Victoria, in a suburb called Mamburun. Very nice. We've got another suburb, Craigieburn. These are either 2-bedders or 4-bedders. So the 2-bedders are around $495 to $500. That is an excellent price for a 2-bedroom house. And a 4-bedroom house is $558. So we have not seen prices in this range for a long time, and that's why Mike found these, because of an affordability play here. So the rentals are $490 and $530 respectively between a 2-bedroom or a 4-bedroom house, and again a 6-month rental guarantee. And it's in this development, this one here, that it's got that clubhouse, which is stunning, as I spoke about, the pool, and it's got a jacuzzi as well, the gym, the pickleball, the netball, the tennis courts. Then display, we've got 2 display homes at the moment if anyone's interested. They are really beautiful, 4-bedroom, 3 living areas, and a 400 square meter home. Guys, these are really huge, but beautiful. They have a swimming pool, the whole lot. You can see the just really beautiful big homes, lots of space, beautiful finishes. The pool outside there. Okay, the prices are not for everyone, but for those who can do it, just look at the numbers. We have the low set, which is a 4-bed, and I think a 5-bed, if I'm not mistaken, is a double story, around about 1.7 million. But your rental is guaranteed at 8%, and you're getting $2,615 a week. So if you think that a very good yield is $1 per thousand, you'd be getting at a very good rent $1,700 a week. But this is $2,615 a week. So as I said, it's rented by the developer. They take care of everything, and they put the house back to a good state when they're finished with it. And you've got a 2-year rental guarantee on this, and an extra 2-year option if you want to continue. So from a cash flow point of view, excellent. And the house is also, this is Bold who did it. They sell these at cost because the spec is so high. They just want to sell them. So you'd make money on the capital price as well, on the price, capital growth, definitely whenever in future that you wanted to sell it. All right, that's some of our options. We do have other options. I haven't gone through all of them. We've got other areas as well. We've also done some deals in Townsville. We've done some in Toowoomba, other areas around Brisbane, between Brisbane and Sunshine Coast, other areas. So that's just some of them. Now, this is a very small, I'm sorry for the size of it, but I just wanted to put this on the screen. I can read some of these out to you. This is our updated, as of June 2025, how we've helped clients. This is just a range of locations. So we work nationally. We're not tied to any particular state. It depends on the research. So over the years, we've got all different locations here, and the acquisition date. So this is mainly what we've done in the last couple of years in Queensland, because you can see 2018, Algesta Rise was a suburb, Banya, which is all Queensland, Heathwood, McDowell. Anyway, this is the year we put the clients in. This is the purchase price we put them in at, this column, and the current value, not what it's theoretically, the current value based on an actual sale. So this is the capital gain the client's got. Let's go through some of them. This first one here, which is a small little townhouse, the client bought for $410,000. They recently sold and they made $370,000 profit. They sold for $780,000. Here's a house and land package that they bought from us in 2020 for $560,000. They recently sold for 1.25 million. No, 1,125,000, sorry. They made a 485 gain. So as you go down here, you can see several at 400,000, 370, 45. This client even made $1 million. They bought in 2017 in Newport for 600,000, and the Newport price is currently around this particular house sold for 1.6 million, and the client has made $1 million on one investment property in Newport. So very good results, 400,000, 300,000. Nothing really. This one is a bit lower than normal, but the client kept it for a very short time, if I'm not mistaken, but still a good result, 175,000. So we're just showing you this. Yes, people would have made money in that state or that city regardless. It's true. However, the suburbs that Mike chose have done above average. There's no doubt about it. They've performed above average. So that's some results. If anybody wants a copy of this, I can send it to you. It's a bit small on the screen. I apologize, but if you can see it, I'm glad. All right, so just to summarize what we've discussed, how we help clients is we first establish the objectives of the investment. When we first meet a client, we want to know why you're buying the property, so that's the objective. Then we utilize the research and see the best match for that client. And of course, we understand the exit point, which we mentioned. Then we just use property proactively to achieve financial objectives. So we help clients create wealth. That's actually what we stand for. And we use property as the tool to create that. We actively manage the client's portfolio. We don't charge any fees. You can talk to us as many times as you like. You can talk to us any year, anytime, anywhere. We don't charge any fees for anything. We are more than a buyer's agent because we give clients the research. If you interact with us looking to buy something, we don't charge you anything. So we do more than a buyer's agent, but we don't charge you a fee. So how we get paid? We get paid by the developer. Every property that gets sold by an estate agent gets paid by the seller. And we are just an estate agent. We get paid by the seller. All our business is repeat business through strong performance from our clients. As I said, we don't advertise a dollar. It's through word of mouth and referrals. So if you'd like to participate, my suggestion is if you haven't got your finance assessed, that's a very important step to start. Get hold of a broker. If you don't have one, I can recommend a few. And get your finance assessed so you know what your borrowing capacity is. And you'll be surprised. Some people don't know how much they can actually do until they get it assessed. If you own your own home and you've had it for several years and you've paid some of the loan down, there is equity there which you could use to purchase another home. I'm just letting you know that. If you've got equity in your own home, you can easily invest in investment property. And it's a good idea to do that. You're making good use of your resources. Some people say, oh no, I'll never want to risk my own home. You're not risking your own home. The new property that you're buying, the investment property, is the security on the loan. You're just taking money from the equity in your home as a deposit, and you'll have a loan for the new investment property, and the new property secures the loan, including the first one, the deposit. All right. If you do want to have a chat to me or understand your objectives, or you're not sure what you can do, or you're thinking about it, or you want to plan, whatever it may be, or you want your portfolio reviewed, please just text me and just say you want to have a property chat, and we can make a date afterwards. So the steps to get involved, I just want to let you know this because the market is very tight. There is a chronic shortage of property. First of all, there's a chronic shortage in the whole of Australia, but there's a severely chronic shortage in Queensland specifically, especially around Brisbane and Sunshine Coast. So if you did want to do something, you need to know what your finance situation is. So when you do see something, you're able to act decisively. And what you need to do, most importantly, is put in an expression of interest after you've seen and gone through the 2 meetings with us. And the EII is not a contract, it's just to reserve it, but you've got to do that quickly. Otherwise, some other agent can sell it. I'm just letting you know that, because people sometimes say, oh, okay, I'll think about it, and they've got 2-3 days, and then when they want it, it's already been taken by some other client who put in the EII before them. And then with contract signing, just to let you know, it's also important to move swiftly. If people don't move swiftly, we've had some developers, it's not nice, but this is the reality. They may take the thing back and sell it to somebody standing right in front of them who's a local person who wants it as their own home. They've got the money to do it. They can do it right now. They're not going to wait for a contract that hasn't been signed for 2 weeks. They'll take it back, sell it to someone else, and say, sorry, you guys take too long. It just is, unfortunately, the game at the moment, and how long that's going to go on for, I don't know, but we've seen that. Also, a trip to the area with myself to see the area. So if you did have the meeting and you did have capacity and you could do it, and you at the second meeting we showed you something you like, then we would take a trip and I would hire a car and I'd take you on a full tour so you can see the place. We could also recommend providers if you need anything, as I mentioned earlier, conveyances, insurance, property managers, handover. If you use the ones we recommend, we're just letting you know you'll get the best results, because we work with a lot of clients in a particular development and we care about all our clients being happy. So if the managing agent isn't great, we'll boot him out if it's needed, and he will lose not one, but he'll lose like 20 because we've put several clients in there. So we take a lot of care to find the best providers that we can. And as an example, the depreciation schedule, if you went and got one on your own, it's about $735 or something. If you did it through us, you'd get a 50% discount. You'd pay $350 for your depreciation schedule just for 2020. Also, the first tenant guarantee, your rental guarantee for the first, 6 months, you will not get that if you bought on your own. You'll only get that if you bought from 2020, because Mike negotiates that with the developer, and we're the only ones who have these specific benefits like a rental guarantee. So better control, if we oversee the thing and it's what we've recommended, you'll definitely get a better result, because if anything goes wrong, we will make sure it's fixed. We want happy clients, and we want to help people who are time poor, but they want to grow their wealth and they don't want to have a lot of things to do all day regarding the property. So we try to take the burden off them. All right, so any questions or feedback or next steps? So let us know if you'd like any of these. If you'd like to understand your borrowing capacity, if you do have a broker, speak to them if you're thinking about investing. If you don't, you can ask me. I can recommend a couple of very, very good brokers. If you're thinking about investing in your super fund, you can't get a loan for residential anymore. That's over. The legislation's changed. You can buy cash, residential, or you can buy an industrial or commercial and get a loan. That hasn't changed. So that's a good thing. If you'd like more information about investment property options, because you're thinking and you want to have a chat, just text me. And if you do have a property portfolio, 1 or 2 or 10 or however many, and you want it reviewed, it's free. We're happy to look at it. We just get together on the phone, collect some information. We look it up on RP data. We do a bit of analysis around several things, and come back to you with our, like suggestion, what we think the market will do, hold it, sell it, whatever, what we recommend if you're interested. And it's for free, it costs you nothing. All right, so that's that. If anyone has any questions, first of all, thank you very much for your time, all of you, and I hope it's added some value and been interesting. But if anyone has any questions, please raise your hand. I'll see you. Just raise your hand or type in the chat box. Robert, I see Robert's waving his hands. Okay, Robert, you can unmute there.
Jeanine, did you mention house on land packages in Victoria for under 300,000? Did I hear that correctly?
No, the land is under 300,000. So the land's actually, in one of them, the land's only 185,000 for the 2-bedroom house. I mean, we haven't seen numbers like that in years. So the land is 185 to 230. It's under 250 for those. And then in the Craigieburn on the northern side, it's under 300, but it's more than 250. It's like 280 or something.
Yeah, all right.
Yeah. But the important thing there is, Rob, is that the people are so worried about the land tax. It's very little.
Yeah, I saw that. I noticed. Yeah. All right. Thanks, Jeanine.
You're welcome. Hello, Fabian. I see that you joined us. Nice to see you, Fabian. You can't unmute, but now you can if you want to say anything.
Hi, Jeanine.
Hi.
How are you?
Good, thanks. How are you?
Good. I wanted to get a little bit of an update.
Okay.
I can certainly vouch for you, Jeanine, and anyone that's watching, that All the properties that we've engaged with Jeanine on have been positive outcome properties. We still are sitting on some of them. So I think Janine's and the 2020 formula of the data is what gave us confidence, and obviously the results that Jeanine has shown with all her clients to all of us tonight about sort of the positive outcomes is real. So yeah, well done for sharing your deals tonight, Jeanine.
You're welcome. Thank you so much, Fabian, for your kind words. Yes, Fabian's a valued client of ours. We've done several things over the years, all kinds of things. So, yeah, thanks so much, Fabian. All right, so if anybody would like to maybe discuss something or you're unsure, please just remember a conversation is free. Just take down my mobile number. There's no links here or whatever. Just take down my mobile number and send me an SMS if you want to have a chat. And if anyone is holding investment property in Sydney still, for example, if you'd like us to evaluate that for you and seeing if it's the right place to hold your money right now, please just let us know. Because if a market or wherever that you got one is stagnant for even just 5 years, but you moved that capacity to a growth market, you could make a couple of 100,000 in the next 5 years as opposed to zero. So we don't advocate sitting on property that's in a stagnant market. There's no benefit in anything. Oh, what about the capital gains tax? You'll make it back plus some. You can see the market, how well they've done. So, all right, guys, thank you so much.
Jeanine, I've just got one question. I missed it. You mentioned the two areas in Victoria. One of them is Craigieburn. The other one was it started with M.
Mamburin.
How do you spell that?
Mambourin.
Eurin. Okay.
No, Mambourin.
Yeah. And what part of is that north, south, east, or west of?
That's south
Uh-huh.
westish, kind of southwestish.
Yeah.
So it's a very new area. The information is too new to speak for itself yet. It's in the very early stages too, so it's still got its at the bottom of the growth curve. It hasn't started to move yet, but it's the affordability play. And I've been there twice to have a look. I was there, in fact, about 2 weeks ago, and it's very, very well presented for the affordability, that income level. It's not a place maybe you would stay, Fabian, but there's a huge demand there because of affordability, and that's the one with the clubhouse. So if you put Mamburin Club
Yep.
into Google, you'll get a video, and you can see the video of the clubhouse. It's very pretty. It's just very nicely done. Terraced homes. So
Yeah. Great. Thank you, Jeanine.
you're welcome. All right, guys. If there's nothing else to say for anyone, then I'll thank you very much for your time and attendance. I do appreciate you taking the time. I hope it was valuable, insightful, and have a wonderful evening. And God bless you all.